Over the past few weeks, we've basically witnessed some massive macroeconomic whiplash in the markets. I mean, we went from what looked like a highly aggressive hawkish pivot from the Federal Reserve to a sudden dramatic reversal driven by just one single set of economic data. So if you've been watching the markets lately and feeling a little disoriented, trust me, you are definitely not alone in this explainer. Every single day, forces you've probably never even heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never understand the signal beneath the noise. And honestly, that's exactly what MacroSignal is for. We are here to decode those signals, objectively and analytically, without any of the usual alarmism. So, looking at the absolute chaos of the last few weeks, it really begs one core question we need to figure out. Which Fed do we actually have right now? Are we dealing with a hawkish central bank that is dead set on hiking rates, or a dovish one that's suddenly reacting to a slowing economy? Okay, let's dive into this and map out exactly how we're going to uncover the real signal from all this noise. First, we'll unpack the hawkish surprise from the latest Fed meeting. Second, that crazy jobs report twist that threw everyone off. Third, a major philosophical shift, the absolute death of forward guidance. And finally, we'll piece it all together into the new Fed playbook. All right, let's kick things off with Section 1, the hawkish surprise. Let's flash back to June 17th. This was a highly anticipated date because it was new Fed Chair Kevin Warsh's big debut at the FOMC meeting. Now, during this meeting, the Fed did exactly what people expected. They held the federal funds rate steady at 3.50% to 3.75%. But beneath that pause, a massive shift happened in how they actually communicated it. Previous Fed statements were notoriously wordy, usually clocking in around 341 words, just packed with caveats. Under Warsh, the new statement was slashed to just 130 words. It was short, it was neutral, and most importantly, it totally stripped out any easing bias. The old references to additional rate adjustments were just gone, replaced by a purely data-dependent tone. And let me tell you, Wall Street instantly picked up on this new, much quieter Fed. And this brilliantly illustrates the internal shift. If you look at the famous dot plot and compare March to June, 9 of the 18 FOMC participants suddenly penciled in at least one rate hike for 2026. This was a wild departure from their prior projections, which leaned heavily toward cuts. Oh, and here's a really fun detail. Analysts at Zero Hedge pointed out that one dot appears to be completely missing from the projections, which most likely represents Warsh himself keeping his cards close to his chest. So why the sudden hawkish flex? Well, it really boils down to four key factors. First, you've got persistent inflation stuck at a 3-year high of 4.2% year over year. A huge driver of that is the ongoing Iran-related energy shock that's been spiking gas prices. On top of that, the U.S. economy is still seeing incredibly strong wages, resilient consumer demand, and this massive surge in AI-driven investment. Firms like Citadel Securities had actually been warning that these exact factors could fuel September hike risks, and honestly, this meeting seemed to validate that entirely. Which brings us to Section 2, the jobs report twist. Literally just 2 weeks after that hawkish meeting, the economic data bit back hard, and it completely scrambled all those expectations we just talked about. It all centered around this one number, 57,000. That's the number of new U.S. non-farm payroll jobs added in June. It was the absolute smallest rise we've seen in 4 whole months. To really grasp why this was such a shock to the system, you gotta look at what everyone was expecting. The forecast was for 110,000 new jobs. The reality, 57,000. They missed it by nearly half. And one of the wildest details buried in this report was that the leisure and hospitality sector actually shed 61,000 jobs. I mean, think about that. People were banking on a huge boost from World Cup tourism, and instead, jobs were lost. Meanwhile, the unemployment rate did fall slightly to 4.2%, but that was largely just because workers gave up and left the labor force altogether. Now, what's really interesting here is how traders reacted. Based on the CME FedWatch tool, right before this jobs report dropped, traders were pricing in a 66% chance of a September rate hike. Almost instantly after the data hit, those odds plummeted to 50%. Basically a coin flip. The market looked at that cooling labor data and decided, you know what? The Fed might not actually have the runway to hike rates after all. And if you want to see the ultimate real-time indicator of the market aggressively pricing in lower interest rates, look no further than gold. Right after this data came out, gold shot past $4,170 an ounce, hitting its highest level since June 23rd. Because, as we know, lower interest rates decrease the opportunity cost of holding a non-yielding asset like gold, making it way more attractive to investors. Combine that with the fact that central banks recently added a net 41 metric tons to their reserves, and you can see capital flowing incredibly fast based on this single dovish data point. Moving right along to Section 3, the death of forward guidance. So we have a hawkish Fed meeting that gets immediately undercut by dovish economic data. How do we even synthesize this whiplash? Well, we have to look closely at Chair Kevin Warsh's fundamental philosophy. For years and years, central banks have relied on this tool called forward guidance. Essentially, it's when policymakers explicitly signal to the market where interest rates might be headed over the coming months or years. It was all done in the spirit of transparency, to soothe markets and prevent panic. But under Warsh, that era is pretty much over. This quote right here is absolutely crucial to understanding the new reality. During a recent panel in Sintra, Portugal, the moderator tried to press Warsh on the economic outlook. Warsh just completely shut it down. He said, "You're back to forward guidance. I'm going to disabuse you of trying to extract that. No forward guidance, no forward guidance." And he's not an outlier here. At that exact same panel, ECB President Christine Lagarde, Bank of England Governor Andrew Bailey, and Bank of Canada Governor Tiff Macklem all totally agreed. Their stance is that in times of extreme global uncertainty, like an ongoing Middle East conflict driving energy shocks, trying to predict the economy is just a fool's errand. Which finally brings us to Section 4, the new Fed playbook. So, what does a central bank that outright refuses to give forward guidance actually mean for you, the focus learner, and your money? Well, it means we are in a totally new normal. Warsh has been explicit about wanting to return to first principles. This Fed is going to be a much quieter institution. They're going to make purely data-dependent decisions, meeting by meeting, rather than spoon-feeding the market a predefined roadmap. To get this done, Warsh actually established 5 new task forces to review everything from their communication strategy to the raw data sources they use to track inflation. And one massive wildcard they are watching closely: artificial intelligence. Warsh has hinted that even though inflation is running hot right now, if AI can meaningfully boost worker productivity across the board, it could naturally cool inflation down the line and eventually pave the way for those rate cuts. So, that crazy whiplash we all felt? It wasn't really the Fed constantly changing its mind. It was just the market frantically reacting to a central bank that is now forcing us to watch the raw data just as closely as they do. Which brings me to a final question for you to ponder today. Based on everything we just covered, is Fed Chair Kevin Warsh actually hawkish, or is he just being incredibly cautious by stripping away forward guidance during a volatile time? I want you to vote in the comments below, but more importantly, tell me your reasoning. Don't just leave a vote, apply what you've learned today, back it up with the data, and let's get a real debate going. Thanks so much for joining me for this explainer, and I'll see you on the next one.